you want to be lending 100 million a year, you need to have pretty deep pockets, hurt money or skin in the game. We love it when people are putting hard cash in. You're not putting capital out the door. You're not making any money. If you're not making any money, your business is going backwards. You've done really well over the last 4 or 5 years while the market's increased by 20%. What have you done when the market's been tough? When a valuation is downvalued? Or can you challenge that? And the answer is no. I've got a brilliant recent example. I probably shouldn't talk about this one.
Hello, everybody, and welcome to another episode of Property People. Today, I'm delighted to be joined by James Farge. How are you today, James?
Yeah, good, thank you. How are you?
Very, very good indeed. Very excited about today's discussion.
Good.
Purely because you've got such a interesting background, and what you're working on right now is multifaceted as well. So
Yeah.
it's quite a long intro because you're doing so much, but let me go through it, and then we can go from there.
Go for it.
James, you are the sales director of Catalyst Property Finance and the managing director of HIVE and Partners. Catalyst, your role entails the management and structure of all loan origination, whilst also a board director responsible for overall strategic and operational direction of the business. Catalyst alone, it issues over 3,000 formal terms per annum.
Yep.
Valued around 2 billion, managing to complete in excess of about 150 million of secured short-term facilities. If that wasn't enough to keep you busy, you're also the managing director of HIVE, and HIVE, the goal is to redefine traditional estate agency, which is becoming more and more outdated in today's digital economy, utilizing modern methods of marketing along with exceptional customer service. Now, HIVE is a platform agency providing expert agents with all the tools to excel in delivering highest sales activity for all of your vendors.
Good summary.
There's lots to go into there. However, before we get into all that, where I like to start is, who was James at school? Did you always know you'd be in property? Did you always know you'd be an estate agent? Did you always know?
No.
I knew I was going to be an estate agent. Did you?
Oh, no, absolutely not. Who was James at school? I was a pain at school. I went to school. I actually grew up in Windsor, just outside of London.
Very nice.
But all my family are kind of Bournemouth based. But James at school was a pain. I wasn't massively academic, but I was very much into playing rugby and rowing and doing various other bits and pieces. I actually originally wanted to go into the armed forces. So my dad's side of the family are all Navy. So I did all of my kind of board and tests to go to be a potential Navy officer. And then I also wanted it, my secret kind of hankering was to go into the army. So I did all of the same to go to Sandhurst. And I actually got accepted to go to Sandhurst, and in the end didn't end up going, partly because when I was 19, I'd literally just been accepted, and my dad passed away. And so I wasn't kind of mentally in the right frame of mind to go to Sandhurst. So they deferred my place, and they kept on deferring my place until I was 28. And I never ended up going because I fell into working as an estate agent and kind of fell in love with it and never came out of property again. So
the love for being an estate agent, I think, is not shared with many people.
I
I always wanted to be one growing up, and you fell into it, but fell in love with it. So I'm not surprised by that because of the love and passion that I've got for the industry. But how did it become that you fell into, did you just think, okay, I need to get a bit of pocket money while I'm not going to Sandhurst? And then how did the job for estate agency come about?
Yeah, so it kind of came about in that I'd finished my A-levels. I decided I wasn't going to university because I was meant to be going to Sandhurst. And deferred my place. My dad had passed away, and I was knocking about doing various little jobs. I'd worked
For
at
example,
a bar.
right, yeah.
I'd worked at a golf club, at a pro shop. I did various kind of, stuff that you would normally do with no real
Pocket
direction.
money here and there.
Exactly. And, I kind of thought to myself, well, I'm not going to be going to Sandhurst anytime soon. So I need to do something. And it was the good old days where you would open up a newspaper and flick through and find your jobs. You wouldn't, you didn't go on the internet. And I thought, estate agent, that's it. So this is 2008, right? So I opened up the newspaper and thought, selling houses, they're looking for an estate agent. I thought, that's easy. I'll do that. Right in the middle of the financial crash. And so I joined. I started at Connell's.
Connell's, yes.
So corporate
Nationwide,
agency,
yeah.
And yeah, it kind of took off from there really. So I was running my first branch within 9 months of starting an
Wow.
agency, which is a little branch in Amesbury, just outside of Salisbury. And it was basically given to me because I couldn't do any harm with it. It was failing badly. It had made consecutive losses for about 8 or 9 years, and they were thinking of shutting it down. And it was kind of, here you go. You can't do any wrong with it. If it works, great. If it doesn't, it's not your fault.
Yeah.
And we ended up turning a profit for the first time in like 8 years within 12 months of me being
And
there.
what was it? So tell us about being an estate agent. So what was the first month? Kind of how did you bed into that? What were the roles that were given to you? What were the tasks? And then who was the manager that was kind of running this failing kind of estate agency? What was the atmosphere like?
So I actually started in Salisbury with Connells, and the good thing about any kind of corporate agency is they give you great foundations and great training. So my area director when I was there was a guy called Graham Archer. Graham is still the area director in that role now. He's been there 36 years, I think, something at Connells. So he's been there a long old time. And he was amazing. He was one of those people that, you sit in a room with, you have a conversation with him, whatever he's selling, you're bored. Like you're
You're
sold.
buying that.
Very charismatic, brilliant guy. And so a lot of my kind of early doors was, get into the branch. It was old school. So we had like almost like Rolodex. Remember the old
applicant
Rolodex
cards.
with kind of applicant cards?
Yeah.
And you'd pull those out and you'd be banging through phone calls and speaking to people, trying to get them to go and see houses. And it was a lot of that type of stuff. And then it really just developed, and I got put on various different courses. So the start was an induction course, and then it moved on to a valuations course, and then it moved on to a management training course. So I got some really good foundations early doors within, a very short period of time of working with a relatively large, or pretty large corporate agency, which I still use a lot of the foundations that I learned then today, even though it's in different business sectors and different industries. A lot of the kind of basic training that I got on management training was really good.
Makes sense. Yeah, I mean, I worked for a couple of corporates, and it's true that once you get these area directors tend to stay in those positions for a very long time. They've got very, very nice six-figure salaries with good packages and stuff. So it doesn't surprise me that the one for Collins has been there as long as you have. So when they finally gave you this branch to run, were you scared? Were you kind of hesitant? Were you kind of
No, I couldn't wait for it.
Yeah?
I couldn't wait for it. I was so excited because it had been failing for quite a long time, and I was pretty cocksure of myself at the time. So, I knew that I was going to go in and rip it up and, change the estate agency world and, light everything up as you are when you're 20, 21 years old. And it was this, I don't know if you know Amesbury, but it's a little town just north of Salisbury. It's a heavy military town. So it's right on the edge of, the Salisbury Plain. So you've got a lot of different kind of military establishments. So 95% of our buyers were from the army. And it kind of coincided really nicely and fortuitously for me in that there was a massive development just on the outskirts of Amesbury that was being built by Persimmon Homes called Archer's Gate. That's now got something like, I think it's getting on for like 4,000 or 5,000 properties is now being developed in that area. And it was when they were bringing all of the military guys back from being away in Iraq, and they were posting them back onto Salisbury Plain, and they were bringing them back from places like Germany. So I had this inbuilt applicant database that just so happened to land in my lap at the same time as them building one of the largest new build estates that Persimmon Homes at the time had been developing. And I managed to get the sole agency contract on that site by just taking donuts up to the girls that were on site. So I started picking up the odd deal, and then phase 2, we ended up getting loads. And actually, when I left, it kept on going for years afterwards. So one of the highest performing mortgage brokers within the business, in the whole Connells business, was in Amesbury, because what he ended up picking up was all of the Archer's Gate business off the back of it, and doing all the mortgages for these military guys. So it was an interesting time, because the area was, the branch was failing pretty badly, but actually through having, I suppose, a bit of luck and timing and other bits and pieces and a bit of tenacity, I ended up getting all of these brilliant new sales contracts, which then saw us through.
Which I think, the story of success for so many different people, I think you have to have a little bit of luck and timing and the tenacity. All of these things need to align, because if you're in bed and all that's happening around you, you're obviously not going to make the most of it.
100%. Yeah, and that was key with that branch, which was funny.
So that was the estate agency, being in the right place at the right time.
Yeah.
Making sure that you're there to make the most of that. And then how does the property finance come in?
So in between that, I set up my first company, which is a company called Greenroom Group. And that company I set up with a friend of mine who I'd met whilst I was at Connell's, Jason. And it was a company where we did various different investments, property-based investments, off-plan stuff. So we would get access to off-plan real estate where the developer couldn't yet draw on their funding because they needed to get a certain amount of off-plan sales in place before they could draw on their funding. So we would get access to a number of different sites all over the world. So we were doing stuff in New York, we were doing stuff in Germany, Cayman Islands, Cape Verde, across the UK. And we, at the time, it was when we had a huge amount of kind of Chinese and Russian investment, Far East investment coming in. And we were working with all different types of wealth managers and mortgage advisors and people up and down the country who were introducing these people to us. And we had the contracts in the UK to be able to introduce these investors to those sites. So I had several years working there in my which taught me so much about
kind of overseas real estate investment stuff, off-plan developments.
Yeah, absolutely. And so I did that for 3 years. I had that company. I then wanted to grow it. Jay wanted to keep it kind of the size it was. So I ended up kind of going on to pastures new. I was 25 years old, a bit older than that actually, probably 28 years old, 29 years old. And he wanted to just keep it. So he kind of keeps doing that today. That's still running now, and it's kind of he's morphed it a little bit, and it does slightly different bits and pieces, but that still goes. And then after I kind of left that business, I found a bit of no man's land for a year or so, and I was kind of didn't really know massively what I was going to do. Did I set my own thing up again to get back into agency? So I went and worked with a friend of mine who owns a recruitment company, helped him with his recruitment company for 12 months. And then I met my now wife. So I was in Winchester at the time. She was a teacher living down in Bournemouth, and it all got quite serious quite quick. And it was like, well, you can't move because you've got a very good job in a school that she'd been in for, I think at the time, like 6 or 7 years. I was just kind of helping out a mate in a recruitment company.
Yeah.
So I decided to move down to Bournemouth and really then look at what options I had. And it was at that point that I thought, I really want to get back into agency. I've been out of it for a little while. I had my own company, which whilst it was still dealing within real estate, it wasn't within the estate agency. So I went and worked for an independent agent down in Ferndown, which is a great company, again, owned by a friend of mine. And my role was to come in and work within that branch, but also to work specifically within, they're the Fine and Country license. So they worked very, very closely with Fine and Country. So we used to deal with kind of mid to upper quartile type property sales, £500,000 plus. And I was there for 2 years. We grew that business really nicely. I got to a point where I was reporting directly into the owner. There was 4 branches. He didn't want to grow it any further. It was a really lovely lifestyle business for him. He had no plans to open anything else. There was no kind of additional commission opportunities for me.
Yeah.
And I had to look at what do I do? And I looked at kind of the estate agency model outside of London, which I was pretty disillusioned with. And I thought, well, where do I go? Do I stay where I am, which my earnings are here,
Capped.
but they're capped. So my feet are under the table. I've got a job for life, but is that enough? And the answer was no. So do I leave, walk into another independent agent, same processes, different logo? That didn't really appeal. Do I go back into corporate agency and climb the ladder and become an area director? I wasn't really interested in that. At the time, it was the surge of Purple Bricks was still going.
Online.
So do I go and work for Purple Bricks or Yopa or, there was Easy Property, there was loads of them, weren't there? And I was like, well, I don't really believe in the full kind of online only type agent. I certainly don't believe in this upfront paying.
The model of the online agent is questionable.
Massively questionable. I never believed in it. Do I set my own thing up? But the reality in setting my own thing up is only 250,000 quid. I don't have 250,000 quid. And all I'm going to do is I'm going to set up an agent, which is the same as all the competitors on the high street. So, why? And so it was at that point I started kind of opening my horizons a bit. And I went down the usual road of speaking to various recruitment consultants and bits and pieces. And I got introduced to Chris Fairfax at Catalyst for a job. And it was an instant click. Chris and I get on really well. We're very similar in lots of ways, very different in other ways. But when I went for my interview, Chris was the co-owner at that point of a packager called Positive Lending, which is down in Ringwood. And he'd just set up Catalyst. And it was, I think, 12 months, 14 months in, something along those lines. Chris, Anna, Matt, and Aaron were the only people that were working at that point at Catalyst. And so I went for my interview and went in, and we were walking up the stairs to the boardroom because it was Positive was sat upstairs and Catalyst was downstairs. And Chris just kind of flippantly, as you did, how are you? What are you up to this weekend? I think it was a Friday that I was having the interview, so I started talking about various bits and pieces. I said, "Oh, what about you?" He said, "Oh, I'm doing this and that with the kids. I've got a son called Ari and I've got a daughter called Dylan." And I said, "Oh, I love the name Ari. I used to watch a TV show called Entourage."
Oh yeah, Ari Gold.
And he went, "No way." He said, "I love that TV show." And so basically we talked for probably 20 minutes about TV, different TV shows that we liked, what we were binge watching on the weekend. And then he was like, "Oh, right, I better start talking to you about the job." So we kind of briefly kind of outlined what bridging was and how it was changing and what he wanted to do. And then very briefly outlined that, I'm looking for someone to come in and kind of head up the origination and start things moving forward. But I'm not really sure, hopefully we're going to go down this road, but we may go down this road. And it was all kind of a bit up in the air. And kind of at the end of that 10-minute, he was like, "Look, I really like you. I'm going to offer you the job." And I was like, "Oh, right, great." And he went, "Oh, I shouldn't say that." He said, I probably should make you wait, really, shouldn't I, and see if you want it first." And then, I've said it now, so I'm going to offer it. So I ended up leaving the interview, going home to my now wife, who, as I walked through the door, went, "How'd it go?" I said, "Yeah, really well. Lovely bloke. Got on with him really well. He watches Entourage. Big tick in my box." And she goes, "Oh, great. So what next?" And I said, "Well, he's offered me the job." And she went, "Oh, that's amazing. What is the job?" I said, "Well, I don't really know." Right, okay. And like salary, we haven't discussed it. Okay, and so what are you going to do? I said, "Well, I think I've already accepted it." And that was 4.5 years ago.
4.5 years later.
So we're 4.5 years later. I like to think I know a little bit about what I'm doing now. And yeah, it was mad. So getting into finance, again, I fell into agency, and I actually fell into working within finance as well. But for me, it's been a phenomenal ride. The last 4.5 years have been amazing. It's completely changed my life for the better. So yeah.
And these, it's a lender. Catalyst is a lender.
Yeah, principal lender.
So what was the difference between positive lending and Catalyst?
Yeah, so positive lending is a business. It's a package. So basically, it's a broker, specialist finance, works with all of the major lenders, and they derive a lot of their business from mortgage brokers who maybe don't often see specialist deals. Could be bad credit, could be bridging, could be development finance, whatever. Those guys are then the experts. They package those deals out. They go to the relevant lenders that it's going to be suitable for. They get the deal placed and get a procuration fee, and then that's shared with whoever the introducing party is. With Catalyst, we are a principal lender, so we hold credit lines with an array of different institutional funders, and we effectively underwrite and make the loan. We are the lender of note and lender of record. So we are making the decisions rather than seeking for the opportunities to find a loan.
And why? Because that was going to be one of my questions: is how you're funded, which you've answered already very eloquently. In terms of how lenders price their products, before we even get to that, how is it decided that you would be lending in the bridging and development space, which is predominantly, I think, what Catalyst offer?
Yeah, so it's what Chris is kind of that's what he was known for. So he was one of the most prolific bridging and development finance packages and brokers for best part of 10 years. And he's kind of poacher term gamekeeper. He thought, well, hold on a minute. As a lot of brokers do sometimes with us lenders, they get a little bit peed off at times that we're not doing X, Y, and Z. And Chris was certainly not immune to that. So he went about thinking, look, I've got a great ability to originate. And originally that was very much through the positive origination channels. So it was kind of like, well, look, we can build an in-house lender. This makes complete sense. We can close some of the gaps that we see that are in the market at the moment. We've got that origination. So now what we now need to do is go and find the capital.
It is a very common
occurrence. You see it a lot. I mean, Danny Waters and Enver is a prime example of that with Bus One, in exactly the route that they ended up going down. And so, that does happen quite a bit. And because of the origination, institutional funding, that's one of the biggest things they want to look at,
Yeah,
right? Okay,
exactly.
how are you going to originate this stuff, and what type of deals are you going to originate? And so Chris was able to put together with Matt and Anna, a really good kind of understanding of what he was good at, what Positive were good at, and what he would be able to originate, and therefore he was able to get institutional funding pretty quickly. The first funding line, if I'm not wrong, because I wasn't there at the point in time, but I was One Savings Bank, so it was a pretty big, kind of
big deal.
institutional facility straight off the back. And then obviously others have come as a result, and yeah, we've kept on going. But it was the decision in terms of where the angle that Chris wanted to go down was very much on his background and experience.
And then in terms of the pricing of those products, so you decided, okay, we're going to do bridging development. That's our background. We've got a good origination machine, so we can source some really good quality borrowers and projects. How does the pricing come into it? How do you know what you're going to price at?
So it all depends on your own costs. So it depends on how you're funded. So we're funded through institutional funding lines, as I mentioned before. So those could be, and there'll be a range of different lines depending on which lender it is. And they'll also do different structures. So you can get things like forward flow agreements, which is where effectively the deal never sits on your balance sheet. It moves on to that of a funding line. They fund, in some instances up to 100% of the funding, and you're the origination source. You can then also get wholesale lines, which go down the road of, providing you with an advance rate of, 80%, and then you have to plug 20% of the loan. So if you're making £1 million loan, then 800,000 quid will come from your funding line. £200,000 will come from your own equity involvement. It really depends on the structure. All of those capital sources come at a cost, and they come at different costs depending on the risk. So in very kind of simple terms, and it isn't this simple, you take your cost, you decide on the margin that you're looking to make, depending on the risk that you're putting out the door, and that is how you build your pricing. There is obviously elements to that which then end up changing. So sometimes you will bring in senior debt. And let's say you do have like a revolving credit facility. So you've got this 80% advance rate. You need to put 20% in. If you want to be lending 100 million a year, you need to have pretty deep pockets to actually being able to lend those sums of money. So what a lot of lenders do is they then bring in a junior participant, which can either be way of private investor or some kind of mezzanine structure, and they will inject that through there. But that will come at a much higher coupon. So effectively, lots of people will try and put like a deal stack together where they've got the senior, yes, they've got their junior participation, and they will still need to put some equity in, and then the blended cost will give you obviously your cost of capital, and then you price depending on what you want your margin to be.
And that's interesting because there has been since 2008 this huge growth of specialist lenders that are funded exactly in some of those ways that you just mentioned, which traditionally back in the day was all banks, it was deposits. The money that would come in, you'd get some money for your savings and then lend out at a margin. Whereas now there's these private equity, private debt structures, family offices that are doing it in the way that you guys are doing it, and just adding their margin based on their own cost of capital.
Yeah, exactly. And the high street's a really interesting one because they've just got more and more nervous with any kind of specialist, what they view as specialist lending, and leverages have got lower. Rates are lower with banks, but you need to inject more capital. So it will work for lots of people that want, that don't mind injecting large sums of equity. But ultimately, if you're looking to, I used to build gearing models when we used to look at buy-to-let lending, going way back. We used to look at how we could gear people using different types, and it's exactly the same. It's no different. So you will get people that want higher leverage that are happy to pay a slightly higher cost because it means that they can operate instead of one or two sites or one or two developments, they can spread it to 5 or 6, and they spread their risk accordingly as a result. And whilst the margins may be slightly lower, it's across a greater volume, which means actually they're probably going to end up netting roughly the same, but it's going to reduce the risk to them personally.
And when we're talking about risk, lenders managing risks, what sort of mechanisms, what sort of levers can you pull to manage your own risk when you're putting out products and rates and terms?
So we use lots of different levers and we look at lots of different things. Our kind of view at Catalyst always has been that it's a blend between the opportunity and the sponsor. We obviously take charges on assets. We can take corporate guarantees. We can take personal guarantees. We can structure loans in different ways where we can staircase our leverage. So it may be that we start higher and generally if let's say you've got a deal where it's multi-asset. So you're going to, I don't know, refurb 4 or 5 different properties on one loan, and then you're going to sell those or you're going to refinance them. We will get the benefit from 100% of what those proceeds are back first before the developer investor realizes their profit. But there's lots of ways that we structure deals where sometimes we release funds throughout the process. It may be that you get below 60% or 55% loan to value, and then you can start having a little bit cash out of each deal. So it really depends in terms of like the structuring of deals. But in terms of the security, generally it's the first charge on the target asset. Sometimes we can take charges on additional asset to provide us with a greater collateral pool, which enables us to then leverage higher and get more cash out. So we do a lot of 100% type purchase deals by bringing in different assets into the pool. So yeah, there's loads of different ways that we can do.
And then, when the economy is going through a turbulent time,
Bit like now.
And interest rates are running wild, and inflation's going crazy, and wars are happening on the continent, and you're starting to get worried about, is there going to be a dip in the marketplace? Is that when you sit around? From experience being a lender, we through COVID thought, right, the world's going to go into lockdown and there's going to be some sort of zombie apocalypse coming through soon. What can we do to make sure that we still stay in business, but at the same time manage our risk? And typically we would look at levers such as LTVs or LTGDV if you're doing development finance. And then the rate as well, you might want to put up the rate a little bit just to be able to, especially with development finance or bridging where you're rolling up a lot of the interest, so your net day one position gets to that little bit lower. So you're risking or getting less exposure to the capital. Is that something that you guys do as well?
Yeah, we're constantly looking at what we can do and where we can. I think there was a big shift, 2008, 2009. And we spoke about this the other day briefly at the do that we were at. But the market ran wild with all different types of lenders lending, 100% on one asset, 120% on another asset, all this crazy stuff that went on. And ultimately, it was the banks or all the different funding lines that behind, whether they were family offices, whether they were pension funds, that took the hit on those, right? Because whilst it hurt developers, it absolutely did. A lot of them handed the keys back, went bankrupt for a period of time, but actually it was a lot, when you multiply that hundreds and hundreds of times over, it ends up hurting a lot of these financial institutions. And so what has happened is when you look at today, leverages compared to 2008, prior to 2008, leverages are a hell of a lot lower. So, we typically, our book at the moment is leveraged, I think somewhere in the region about 65% gross. And then a lot of our stuff, a lot of our interest is retained and fees and other bits and pieces. So, we're not over leveraged. There's quite a lot. So if the market dropped by 20%, we're still nowhere near 100% of the value of those properties. Now, there's going to be situations we need to work through, and there are going to be properties that, potentially we take a bit of a bath on. But we should have enough of a blend across the book, which makes things, kind of reasonable.
The portfolio theory.
Completely.
You're never going to have a 100% payback rate. You're never going to, especially on time.
100%. And that's what it comes down to. So we look at that a lot. We also look at, and this is a great term within lending, hurt money or skin in the game.
Yeah.
We love that. We love it when people are putting hard cash into stuff because they're as invested as we are. So they're not going to want to lose that. Now, lots of people try and work deals on soft equity through planning uplift, which is absolutely fine. Like, I totally get you also not going to walk away from the potential profit of X, Y, or Z, or the existing value. Now you've added that value in because you've had a planning gain. But we always look at that type of stuff as well. So yeah, leverage is key. Rate is something that we control. Skin in the game is something that we look for. Experience. That's the other thing. The other thing we're always looking at is, okay, great. You've done really well over the last 4 or 5 years. well, the market's increased by 20%. That's brilliant. What have you done when the market's been tough? What did you do in 2008? What were you doing at those points in time? Where were you when Brexit took place? We look at, okay, how have you developed your career? What were you doing? And how do you control that process as well? So those are the things that we really look for, the levers that we pull that you mentioned in terms of leaning on what's a good deal and what's a not a good deal.
Yeah, I think that's important. I get that asked being a finance broker almost on a daily basis. Especially from people that are entering into the marketplace saying, I don't own my own home, or my income is only so much.
Yeah.
And I'm like, well, those are all important factors. But at the same time, I think what's more important is what's your track record look like? And if you're just starting out, yes, you will need slightly more equity in the background. Yes, you might need to put in more cash to get the project going. But if you've got a track record that spans 3, 4, 5, 10 years, that you can lean on a lot more than having lots and lots of money in the bank. I think that's a successful track record, so showing that you've been able to navigate certain markets, volatility, etc., or projects that have not gone quite to plan, and you can kind of talk about how you made sure you got through it and made sure everyone got paid back, even though you didn't make a massive profit or a small loss. Those sorts of experiences. Problem solving, I think, from a lending point of view, gives you a lot of confidence.
Oh, we love stuff like that. We had a borrower not that long ago come to us, and he had a scheme, a pretty big scheme.
This episode is sponsored by the PLMD Group. PLMD Group is made up of the PLMD Development, PLMD Estate Management, and PLMD Capital, providing expertise in real estate development combined with asset management. With more than 70 build-to-rent properties and £20 million of assets under management, PLMD's extensive knowledge of local planning policies have resulted in a strong track record, turning liabilities into valuable assets. The group delivers value through a fusion of experience, innovative design, imagination, hands-on management, and sustainable resources. To find out more about PLMD and the services they offer, head to plmdgroup.co.uk.
As well, it was I think over 50 units, right? So not a small, and he'd done a lot of development prior to 2008, and he personally did very badly through that period of time. But one of the things that was really impressive about him when we kind of looked at his portfolio and what he had done in the past was, even though none of the schemes that he'd done in that period, and a lot of them took a loss, he took the loss.
Yeah.
So all of his contractors were paid. He had no suppliers that took him to court. All of that type of stuff. It wasn't that he just shut down an SPV and walked away and went, right, forget this, I'm not involved anymore. He managed all the way through and kept a reputation. And so it took him a while to get back on his feet. But actually, we really like that, because when that came through to me, and this isn't even a deal application, actually, I'm hoping it does go to application soon. But when I looked at it, and people turn around and go, how do you know that this now scheme is going to work? Well, you don't. You don't know the scheme's going to work, but I'm pretty confident that he's going to enable us to get our money back, because his track record has demonstrated that.
Because you got the jockey and the horse thing, which also came up the other day.
Yeah.
You're looking at the person at the end of the day, because you could have the most profitable deal in the world, and somebody that doesn't quite really have gives you the gut feeling that they're going to be able to get out of bed and make sure that they're going to roll their sleeves up and make shit happen if things start to get difficult, which inevitably it always does at some point. Yeah, exactly. So you're always, you answered on the day, you back the person, the jockey, to be able to navigate through. If there's a tighter margin, you'd rather do that deal than the other one.
100%. And it also comes down to using the analogy jockey and a horse. The horse is theoretical, right? Your profit, it may be the most profitable scheme in the world on paper. Until it's delivered, it's just a bunch of numbers, right? Whereas the individual that then is behind that, of course you need to have a decent scheme. If you've not got a decent scheme, it doesn't matter how good the person is. If it's loss-making on paper, it's going to be loss-making in real life. So, but the people behind it are then really, really key. So if you've already got, okay, tick in the box, we've got a profitable scheme, there's a starting point on paper. And there are some margins, and they've built decent contingencies in. But then the people that sit behind it, that's then what we really want to look into. So how are you going to turn this theory into reality? And that's why you should always back always back the individual or the team that is delivering.
Makes sense. Makes sense. So, in these turbulent times, valuations.
Oh wow, here we go. Go on.
So what's been your observation? I mean, it's something that came up the other day. Just for context, you were on a panel, an
Yeah.
expert panel that we did at the Central London Property Meet, literally a week or two ago, and some of these questions came up then, and there was an array of other lenders and brokers, but this has been something that's, as you can imagine, both of us being in the finance space, we get asked a lot, or we come up against these things. From where you're sitting, even from the estate agency side,
Yeah.
value is going out. What is your interpretation of the way that properties are being valued now, and where expectations are for either sellers or borrowers?
Okay, so I think generally speaking that there is a nervousness in the market around valuation from everybody. It's one of the first things we hear before we get a deal going to application. The first thing a broker or client will say to us is, "Can we get the valuation booked?" Because they're desperate. They don't want to invest a single penny more of time, effort, or money into legals or anything along those lines until they know, right, okay, we've got the right numbers on the valuation. And so everybody's a bit nervous around that, including valuers. And valuers are obviously incredibly worried about PI costs and claims against PI and all this type of stuff. So, and then they're also trying to look into the future, but they're also looking backward because valuers are asked to provide a valuation on what's happened 6 months ago based on the prices that were agreed back then. Well, in a declining market or stagnating market or whatever, but certainly not in a rising market, that's very difficult to do. So they're also then thinking, well, hold on a minute, I've got a borrower here who's looking to buy X property. I'm using comparables from deals that were agreed 6 months ago, but they're not going to be developed for 9 months. So they're forward looking as well. And they're thinking, okay, how's the economy going to affect what the values are happening, how the interest rate rises, which I still don't think we've seen the full brunt of the interest rate rises in terms of the effectiveness of those and how they're going to affect either positively bringing inflation down, but also how they're negatively going to affect real estate prices. So you got nervous valuers, you got nervous borrowers, you got lenders who are leaning on valuers to provide them with accurate numbers. So what we're starting to see is numbers come in a little bit later than maybe borrowers would hope. And they call that a down valuation.
Yeah.
Hear it all the time, it's been down valued. It's been valued lower than you expected, but whether it's a down valuation or not is another thing. So one of the things that we're starting to notice more and more is not so much on the day one values, because the day one values, if you're just purchasing a property today and you're not doing any like kind of major works, it kind of is what it is. You can use comparables from the past. You can allow a little bit of a reduction, but ultimately it's that old saying is a property's worth what someone's willing to pay. And so if I take the estate agency business that we've got, we're not really seeing any down valuations versus what people are paying. On the lending business, what we're starting to see is that GDVs are being impacted, and therefore residual calculations are going lower against the day one. So what we're tending to find is that people are, I wouldn't say they're overpaying, they're probably paying what the property is worth today, however, or the land or whatever, however, the eventual scheme, the GDV on that eventual scheme is being clipped, and then when you factor in the cost of works and then work out the residual coming backwards, then it's coming in lower than expected.
And they are overpaying effectively when you look at the calculation.
When you go backwards from there. Yeah, exactly. If they were just buying, let's say, I don't know, someone's buying a 3-bedroom detached house and there's potential to develop into a 5-bedroom, push out the back, push out the top, which is typical what we do, then the 3-bedroom house may be worth what it is as a 3-bedroom house, but as a 5-bedroom PD scheme development, it isn't. So we're definitely starting to see some impact there. And that's causing problems, that's causing challenges for everybody, for borrowers, for surveyors, for ourselves. Trying to make schemes stack is becoming increasingly challenging.
So here's where the rub is, I think, in certain circles, or the conversation that goes around. And there was actually one developer that's been around for a couple of decades. There's a belief that lenders have panels of surveyors, and these conversations occur when lenders are saying, you know what, we want to put out capital, we want to show that we're in business, we don't want to kind of switch off because that's how we get paid. So if we don't put out capital, we're not going to make any money this year, but we just don't want to put out as much. So actually, let's work with the surveyors that understand our appetite for risk, and therefore will be a little bit more conservative when they come to value properties. Is that something that in an unwritten rule book happens behind the curtain?
I could only speak for Catalyst, and the answer to that is no. It's really interesting. We often get lenders, the universal group of, often get targeted in terms of, they just don't want to put capital out the door. In most instances, if you're not putting capital out the door, you're not making any money. If you're not making any money, your business is going backwards. So one thing I can absolutely categorically tell you, and anybody else that thinks that may be the case, is that lenders want to lend. All of them.
They need to lend.
They need to lend. They have to lend, right? So in terms of the valuer conversation, we get asked quite often when a valuation is downvalued, could you challenge that? And the answer is no. Unless there is a absolute, like it is negligent what's happened, the answer is no. And the reason that the answer is no is because we stay completely impartial. We won't ever give them an indication as to what we believe the property's worth, and we equally won't fight the corner or try and up a valuation. And the reason for that is because one of the things that we ask for from a valuer is they carry a certain level of PI. We're also asking that valuer to provide us with an independent expert opinion on value. And if we try and influence either positively or negatively, we instantly undo what we're asking them to provide. And we can no longer, if ever challenged, claim on anything of theirs in the future. Either we couldn't call them as a witness into any kind of default scenario. We couldn't claim on their PI if they got it wrong, because we would have been influencing their position. So one thing that we always look for is we look for valuers with a really strong track record. We constantly monitor their performance. And if there is a slip up, this year we've taken off several valuers off our panel who, haven't quite performed to the level that we would expect.
When you say that, what is it exactly they haven't done?
So it could be turnaround times, and they're just missing on their SLAs. It could be that they have reduced their PI cover, which then just doesn't work in terms of what we require from our funding. It may be that because we independently review every single valuation that comes in, so we have those valuations audited. And if a certain percentage of those deals are audited and the audit comes back negatively, then we start to build up a track record that actually they're not delivering on what needs to be done.
Who's doing the auditing?
So we use external third parties to kind of carry out those audits. We also do an internal audit as well, so all of them, every single valuation that comes is reviewed by the credit team. But we also use external auditors to provide that we cover a cost on, in order to make sure that the valuation is, and again in both sides is fair. I mean, I don't think I've ever seen a valuation come back where it's been audited and the value's gone up, but I've certainly seen them come down. But that's not, they're completely third-party companies. So we're constantly assessing, because what we want to have is a panel of valuers that ultimately deliver the accurate information, so that we are in a position where we can make accurate judgments on the deal that's being presented, so we can lend.
And let's assume that you've got, even in this market, which there are deals obviously being done, and people are getting busy, especially those full-time investors, developers.
Yeah.
They can't rest either. They need to be able to get on site and get busy. But things then do take a little bit longer than they should.
Yeah.
You've got COVID, you've got turnaround times, you've got administration, you've got people working from home still, all this other stuff that's been going on. And even sales periods just being a little bit more elongated. When a borrower runs out of time on their facility, typically there's 12, 24 months of development finance. How do you approach those sorts of situations? Because obviously the default interest that's already locked in.
Yeah.
Are you the type of lender that would like, that's how we earn our money, and if you go over, you go over, and that there is, it's all already written in stone?
Yeah.
Or is there an element of flexibility?
We always work with people where we can. So throughout a life cycle of a loan, once a loan's completed, it goes into our servicing team. And our servicing team, every month or so, they're in contact with the borrower. They're speaking and finding out what's going. Even if there's no drawdowns that are happening and there's no works, we'll still keep in contact with them. Are you still on target for the redemption date? If not, where does it look like it's going to be? What are you doing in the background? Can we help you with anything? When it comes to actually doing works, we've constantly got people out on site, whether that's a QS or a monitoring surveyor, providing us with timely, accurate information. Not only for us to be able to provide the drawdown so the works can continue, but also, where are they? How close are they to the timelines on this loan? But we have a very fair approach. As long as people are doing what they're doing, we understand things go awry. Like we were saying a little bit earlier, we have this theoretical value that's going to be achieved. We also have a theoretical timeline based on everything being perfect with a small contingency.
All things being equal.
Exactly. All things being equal, every single developer would be making a shed load of money at the moment. And so what we always do and what we always try and do is work with people. So we have inbuilt structures behind the scenes where, and again, this comes back to where we put loan to values. Okay, what can we do here? Is there some additional leverage that we can provide where we can roll the interest and extend it for 3 or 4 months to allow them time to sell or complete? Do they have the ability, because they've got the financial resource to service the debt on a monthly basis, to then extend them for another 4, 5, 6 months? Is there a way that internally we can now refinance them off of this product, which was a refurbishment product, onto a development exit product and provide them another 6 or 9 months to get the sales complete? Have we paid down some of the debt already because they've got some of the sales achieved? So we have created some headroom in our loan to value that allows us to do that. So we're always looking at these opportunities to say, okay, how can we work with you to still deliver the end result without you being penalized? And the biggest, I suppose, if it was an advice point, is just talk to your lender. Like, keep in communication. The people that we lose our rag with are the ones that we've been trying to get hold of you for 6 months, we haven't heard from you, and 3 hours before your redemption date, you're now telling us that you can't redeem. Those are the people like, why didn't you speak to us sooner? So, speak to your lenders, because actually, if you're with a good lender, and there's hundreds of good lenders in the market, they will work with you and provide forbearance to get through the process, for sure.
When I was the lender, it was almost like a football where you got kind of yellow card and then a red.
Yeah.
But we'd allow a few yellow cards. It wasn't just yellow straight to red. But there was, we used to call them yellow flags.
Yep.
So if there's, that's a yellow flag, that's a yellow flag. And then it's like, okay, I think if you pass like 3 or 4, then like something's not right. I had a developer recently who had lots of little niggly things happen to him. And eventually he was over budget.
Yeah.
He was over time as well. They'd built something incorrectly, so the planning enforcement got involved. It was only a minor thing, but it happened. The contractor walked off as well at one point. So it's like all of these little things that were and then there was a party wall agreement that wasn't agreed, which 9 months into a 12-month loan, when that means you can't even develop a whole 2 units, which is going to knock off a couple of 400 grand off your GDV, and that needs to be resolved. So it's like one too many thing, and the lender then just said, actually, you know what, we they're all small things in the grand scheme of things.
Yeah, but they add up, right?
But they add up, and the borrower just couldn't get his head around why they're blowing it out of proportion. From your point of view, if something like that happened to you, would you feel more sympathy with the lender or with the borrower?
I've got a brilliant recent example. I probably shouldn't talk about this one, so I'm not going to mention any names or locations. I'm probably going to get in deep trouble, but there we go, it's fine. So we made a loan on a semi-commercial asset in an unknown location, and the deal was that they needed to complete on this purchase quickly. Holding Bridge, very well-known developer locally, kind of, to the area, and they we put the holding bridge on, and the plan was, right, we're going to get planning permission. Once we've got planning permission, the exit of your facility is that we're going to refinance out with a big development lender, one of the big ones that you will know very well. No problem at all. We're going to provide your holding bridge. Our security is a semi-commercial asset. Yes, right, great. Completed the loan. As part of our facility docs and our terms and conditions, you cannot make any alterations to that building, because if you needed to default, the valuation is based on an as-is value, and we will disperse of that asset in order to get repaid our loan if you weren't to repay it. They knocked it down. They knocked the whole thing down. Gone. Poof. Just a plot of land, bare land, nothing on it. That causes some problems. Now, they, again, couldn't see our point. Even though it was in the facility agreement, they were fully aware it was just a holding bridge. No works meant to take
I thought you were going to
place.
say they moved a few walls
No,
around.
the whole thing was knocked down. And we've got several options at this point as a lender. The first thing is to sit there and go, what are we going to do?
Yeah.
Luckily, they had planning at this point. So the residual valuation was higher than what the original value was, which is great. So that's a positive. The downside is the funding vehicle that we had lent the money on does not do land bridging. So they're in breach of covenant because of that. And we decided, because along with our institutional line, that because the value had increased, there was no point in defaulting them. Because if we defaulted them and started going down the road of receivership and trying to get control of the assets, then it's just messy. And ultimately, it doesn't really work for anybody.
Yeah, exactly. You want your money back.
We want it as quick as possible. That's now the aim. Give us the money back as fast as you can. And the fastest way from A to B was to allow them to then go and get the development finance, which they ended up getting through.
How did you find out that they knocked the building down?
Someone drove past it who knew that we had a loan on it and phoned us.
Eyes and ears everywhere.
It was one of those where it came through. I remember it coming through, and Amy, who's our head of servicing, said to me, I was like, I'm not getting involved, I'm going next door. I'm staying well out of this one.
It's always a game of case by case, I think, when these sorts of things happen.
100%.
Whether it's my example or that one, it's kind of like, look, what have we got in front of us?
Yeah.
And what's the best way we can get our money back at this very stage?
Yeah, and lots of lenders do different things in different ways, and it depends on how big your loan book is, how many loans you've got out there, what staff you've got in order to be able to do that. Because when you're a smaller lender, it's easier to work with people in those instances. Equally, you also don't want a X £1 million loan going bandy on your loan book when you've got a loan book of, I don't know, 200 million, versus if a loan of a couple of £100,000, £1 million goes bandy and you've got a £1 billion loan book or £2 billion loan book, it doesn't hurt quite as much. So sometimes the bigger lenders probably have a little bit more of a fierce approach when things happen like that, whereas smaller lenders will try and work with people most of the time.
Makes sense. Totally makes sense. So all of this property finance stuff, which I get incredibly excited about, we also have the estate agent. So how is it that people like you and Elon Musk can run multiple businesses?
Oh, I love the fact you've put me and Elon Musk in the same room. Little sleep, lots of stress, a very loving but nagging wife. But no, ultimately, it comes down to good people in the right roles, delegation and trust. That's the absolute key. It's really interesting because as an employee of a business, you're always given a set of responsibilities that you have to carry out. So I have that because I'm an employee of one business and I'm a shareholder director of another business. So I kind of wear several hats. But actually, I treat my employed role as a director at Catalyst the same as I do at Hive. And one of the things I have to do is have the right people in place. So if I kept control of everything, no, let me rephrase that, because you do want to keep control. But if I had to do everything operationally, I wouldn't be able to do it. So I've got an amazing team at Catalyst of people that have worked with me for a long period of time. I've got a guy called Josh who's been with me for 4.5 years. Sam's been with me 4 years. Ollie's been with me 3 years. I've got a head of new business who runs the operational day-to-day sales function within Catalyst and is my eyes and ears, along with some seasoned people within that team. And then on the Hive side, that's a lot younger. It's only been going 18 months. But we've got great marketing support. So Anna, who's the marketing director of Catalyst, also the marketing director of Hive, and she looks after all of our marketing structures. My wife is actually our office manager at Hive, so I've got to trust her. But she looks after, the day-to-day running of everything. We've got a great accounts team that's in place to look after that. We've got really good agents that we appoint. So what my role becomes is very strategic in both senses. So I'm always looking at ways to grow both companies. And actually a lot of it, I try and get some symbiosis through. So I try and cross-pollinate where I can both of those companies so they can help each other and work together. So yeah, I think the key is having really good people and putting trust in people.
Which is an interesting topic of conversation, especially for me, as I'm looking to grow Merry Oaks. From your point of view, how do you say hiring good people and they stay with you a very, very long time? What is it you're looking for? Is it because here's the conundrum. If you've got experienced people, they come at a high cost, and they come with sometimes experience but bad habits. And they're stuck in their ways. If you come with young people, less experienced, but you can mold them exactly how you want and teach them the way that you want them to work in the culture, etc. But then you've got to invest a lot more time in them. And if you're time poor because you're running so many different operations, where does this time come from? So how do you balance those two things? Or what's your preferred route towards that?
So again, it comes back to having decent right hand people. So Rach, my wife, is very much my right hand person within the business of Hive. Vicky is very much my right hand person within Catalyst. And so both of those people, interestingly, came to finance and agency with zero finance or agency experience. And so, touching on the point that you just made about people coming with bad habits but experience, what I've done in that instance is I've trained 2 people to do a specific role for me in each business so that they don't carry the bad habits, but then in turn are the people that I trust. What they then do is they impart the knowledge that I've provided them and what I require them to do into new people coming in for me, but they don't know any different. So instead of trying to go and find, 5 or 10 people that have got loads of experience that have got the bad habits that you need to retrain or refocus, or 10 people that don't have the experience that you are then putting the time in, my kind of philosophy on it has been, right, well, I want to make this as simple as possible for me, but also as effective and as quick as I can for the business. And so by getting 2 people in those key roles for me, I can train them and keep training and developing them, but I'm training one person. And then that kind of goes on from there.
That culture kind of trickles down.
And it just keeps going. So we're recruiting at Catalyst at the moment. We're recruiting for that exact, young grad, hungry, wants to get into business. And part of that is, I've made the decision on that is because we don't have a massive breeding ground of people and talent pool within Bournemouth for specialist lending. There's 2 specialist lenders in Bournemouth, and we've got an unwritten rule that we don't steal anyone from either each other. So we very much want to create our own talent pool. So the easiest way of doing that is bringing them into, bringing some younger people, raw graduate types into more kind of junior roles, and then over time, 2 or 3 years, training them, developing them, coaching them, giving them more responsibility, so that when we have that natural attrition from a senior person leaving, I've instantly got someone that can step up that's already been in the business several years, and then we backfill with inexperience but the right attitude. And it becomes a lot easier in terms of that growth strategy.
Yeah, that totally makes sense. And then with the Hive, it's a platform agency. When you say that, what does that mean exactly?
What does that mean? So, I've sold property all over the world, and the UK market, the UK agency market, in my opinion, is probably one of the most antiquated structures globally for selling property. And so, when I left agency, I was disgruntled with a number of things. Professionalism of the actual industry as a whole. I was really annoyed with the earning potential and the ability to grow a career. I was really frustrated with marketing quality. I was really frustrated with the way that vendors and buyers were treated. I'm really frustrated with the legal system, but there's not a huge amount I can do to change that. But there you go, that's by the by. So when I left, I thought, well, I'm going into something different. Chris and I started talking about agency one day. One of the biggest struggles you have in agency is stock. Well, we got a lending business where the big decision for a developer is, am I going to borrow 5 million quid off you? The small decision is, let us sell them for you. So we've got this inbuilt instructions machine in Catalyst where we can actually go and pick off and talk to developers directly about sales for people that we're funding. We can also find, if you have an agency, we can find land and development opportunities that we can then introduce to borrowers who will use Catalyst, who will then develop what they need to develop and then sell those through the agency business. So that's where the symbiosis kicks in. One of the big frustrations for me in terms of, I suppose, the platform question was the move. You're always looking for entrepreneurial types in agency. But then what agents do is they then quash that entrepreneurialism by putting rules and regulations around what they must and must not do, working time, working locations, if they can use social media or not, how they communicate with people, can they have their own mobile phone and give out their telephone number to prospective buyers and vendors. All this type of stuff is so controlled because agency owners are so terrified that these people are going to, wander off and leave them. And the high street model, I always felt, when you look at, I was looking at some agents, there's one in particular that I did a costing exercise for a number of years ago, and they had 5 offices within an 8-mile radius. And their fixed overhead costs before they employed a single member of staff, put a single property on the market, did anything, just for the offices, the locations in terms of, lighting, business rates, whatever, they were spending £400,000 a year. And hold on a minute. You wake up on January the 1st and you go, right, I've got a noose of 400 grand around my neck. I need to cover that before I pay anybody, before I even start thinking about paying myself. What's the first thing they do? They draw back on all what they see are the unessentials. So that would be things like photography. That would be things like enhanced packages on the internet. That would be things like investing into social media to get you more eyes on your property. And it never made any sense to me. And also what they then do is they push back basic salaries. So people are on like 15, 16, 18, 20K basics with then limited commission opportunities. And so the platform idea is that we provide everything to our agents. All our agents are self-employed. They all get given a designated territory that they can work in, that they're experts in, that's protected for them. There will never be another Hive agent that goes into that area. So they can invest their time and energy into that area, knowing that they are going to get the results and the income from it. We provide them with everything else. We provide them with the platform, the wrapper, the business in a box, whatever you want to call it. And that's marketing, legal, compliance, office administration, physical office presence. We front all of those costs for them. So the only thing that they actually have to pay for is themselves. There is no additional cost. We then have on their success, we have a 70-30 split on the commission structure, and they pay a one-off fee on every single completed deal, which comes off the gross fee, which is 250 quid plus VAT. That's it. So I've got guys who are working with us now who 12 months ago were earning £30,000 a year, that I'm writing commission checks of 10, 12, £15,000 a month. And that's because they're now getting the majority and lion's share of the money that goes in. Our platform is all, the design of it is that it builds on scale. So, the very basic numbers, that if we get to 30 agents across Dorset initially, in 10 designated areas, so they can build teams, so 10 territory partners, 20 associate partners that then work within teams within designated areas, generating circa £100,000 gross revenue per person per year. We'll be generating £3 million worth of revenue. Hive will be making £900,000 gross plus fees, so call it £1 million. The cost to the business are about £250,000. But we've got every single person then in that territory is earning £70,000 a year. So we have 30 of the highest paid estate agents in the entire country based in one county, whilst the business is still extremely profitable. And then we can replicate that into different counties and grow it from there.
That sounds like a really, really good model. It does have a remnants of kind of how the US operates to a certain
100%.
extent. And I've started to see a little bit more of those sorts of agencies coming to the UK. And having a fair amount of success in terms of the few, I think, very highly motivated, driven entrepreneurial estate agents, as you mentioned, taking that model and making their own. So I think that there's a good opportunity for a homegrown UK estate agency to grow that model as well. So that I wish you all the best with.
Thank you very much.
You've obviously been in property for a number of years, even if you fell into it. I love the fact that you've been so passionate about it and creating more jobs and opportunities for so many more people. If I was to ask you what traits or attributes it takes to become a successful property person, what would you say?
Oh, so many. I'm going to try and keep it clips though, because I can talk forever. The number one thing is, I think you need to be passionate about what you do. Every single morning I wake up and I look forward to going in, even though it could be I could have the worst day coming up. I will always still be passionate and solving problems. So passion is absolutely key. Tenacity. You have to be tenacious. You're going to get so many no's before you get yeses. And you've got to go through that pain, and you've got to deal with it, and you've got to embrace it, and you've got to love it. So tenacity is absolutely key. Passion, tenacity, and I would probably say as a third one, unwavering belief. And there's a difference between unwavering belief and arrogance. You can still be humble and have unwavering belief. And that comes down to the combination of the first two. But unwavering belief not only in your product, not only in your aim and your goal, not only in yourself, not only in your brand and your business, but the people that you engage with, your clients, your customers, your third parties, the people that operate within your business. A complete unwavering belief is really important. So those are the three things I think that you need to have.
Very good. James, I really, really enjoyed spending some time with you.
Thank you very much
If
for the
people
invite,
want to
mate.
reach out to you for the Hive or anything to do with Catalyst,
Yep.
what's the best way that they can reach you?
If you want to reach me, the easiest way is probably on Instagram. So my Instagram handle is James Farge, so just one word, all lowercase. And you can find all my contact details on there, on my link tree. So yeah, reach out to me. Always happy to talk to people about anything property related. Yeah, give me a shout.
Thank you very much.
Thank you, mate.